All right. All right. Good morning, everybody. Welcome, welcome. This is the CE class, Show Me the Money and Get Me to Closing. And it is Georgia Real Estate Commission course number 64933. This is for continuing education real estate credit for your Georgia real estate license. So if you hold a license in another state, you are more than welcome to attend for the information, but for CE credit, it is only for licensees for their Georgia real estate licenses. So if you have not already done so, in the chat, please type in your name, your email address, and your real estate license number. We are going to ask you to do that after break and at the end before you leave also. My name is Dana Sparks. I am the director of the Georgia Real Estate Academy, which is the school offering this course for CE credit. And I am so excited to welcome Doug Dean, named partner and closing attorney of Shea Fritz & Dean, as our instructor. So a couple of things before we get started. It does take 3 to 5 business days for the CE credits to be recorded. And the reason for that is we have to pull together 3 reports through Zoom: the registration report, the attendance report, and the chat feature. So we do ask for interaction through the chat. If Doug asks you a question, it's definite. If this is your first Zoom class, welcome. If this is not your first Zoom class, you know the ropes. Different schools have different ways that they interact, but if you've been with the Georgia Real Estate Academy, you know we interact through the chat function, and the purpose is we have to make sure that you are in attendance for the entire class, that you just don't walk in, turn on your computer, and then turn it off and walk away. But how could you with Doug teaching in this great topic? So if Doug asks a question, please go ahead and type in your answer in the chat, even if he already answers it, just again as a methodology of us ensuring engagement by you as the student. So before, and then we're going to take a break, and then after the break, I am going to launch a poll. That's going to be the course evaluation. But before we get started, let me read the notice to students. And again, in the meantime, I'm going to put it in the chat function again. Go ahead and type all that information in. You are muted. Again, we prefer that you interact through the chat function. At the break, you can unmute yourself and ask a question. Doug and I will stay on at the break and for a short while after the class. If you, I have everyone muted, but you do have the ability to unmute yourself. If accidentally you become unmuted, please mute yourself back. You'll see the little microphone and you just click on it and it'll put a red slash through it. So let me read the notice to students, and then Doug, I'm going to hand it over to you. So, all right. Let me make this a little bit bigger. Here we go. All right, notice to students for the virtual broadcast continuing education classes of GREC approved classroom classes. The Georgia Real Estate Academy, which is the GREC School 6915, with the end date of renewal being December 31st, 2022, presents to you the following course of study: Show Me the Money and Get Me to Closing. And that is GREC course number 64933. This is a virtual remote broadcast of an approved in-class course. It is 3 hours in duration and is approved by the Georgia Real Estate Commission for the purpose of continuing education. There are no prerequisites to receive credit. The instructor is Doug Dean, named partner and closing attorney with Shea Fritz & Dean. There is not any required homework. That's a good thing to know now, right? And not any written examination. All students must be on time and present for all remote virtual broadcast instruction hours in order to receive credit for this course. Roll call and documentation of students' real estate license number will be conducted via the chat function, as I just described, at the beginning and end and after the break. Continuing education notice. Students may only receive credit for a specific course number once every 12 months. That means you can take as many classes as you want on any specific topic repeatedly, but you're only going to get CE credit for a specific course number. So you're only going to get credit for this course number, 64933, once every 12 months. If you have already received credit for this course within the last 12 months, you are more than welcome to stay for the information, but you will not receive additional credits. Prohibition of recruitment. No recruiting for employment opportunities for any real estate brokerage firm is allowed in the class or on school premises. Report promptly any effort to recruit on behalf of a brokerage by anyone, including a fellow student, to myself. I'm Dana Sparks. I am the director of this school, the Georgia Real Estate Academy. My number is 678-580-6880, or the coordinator of the school, Heidi Kelly. Her number is 919-8825, extension 306. And there are our email addresses. So let me stop share. All right. All right. Doug, I am going to make you host, and I will let Doug introduce himself.
Dana, thank you very much. For those of you that I haven't gotten to meet yet, my name is Doug Dean, and I'm a partner with the firm of Schaeferitz and Dean. A little 60-second overview of who I am and where I came from. I am a local Atlantan. I grew up out in Stone Mountain, went to Tucker High School, was an engineer at Georgia Tech and then at Delta Airlines. I worked at Delta for 14 years. And while at Delta, I got this crazy idea to go to law school at night. My first day in law school, I met this fellow, Richard Schaeferitz. We were both part-time night law students, full-time day jobs, and both of our wives, we found out, were pregnant the first week of law school. So we had a lot in common. We helped each other study, get through law school, pass the bar, and then went separate ways. As luck would have it, we both wound up being real estate attorneys. We had separate firms, and one day we said, why are we doing this separately? Let's do it together. So we formed Schaeferitz and Dean, January 1st of 2008, which everybody knows was the best time to start a real estate venture, right when the bottom fell out of the market. We persevered through a lot of downtimes and actually have a success story to tell at the end. We've grown Schaeferitz and Dean to have half a dozen attorneys, 24 support staff, and a dozen locations across Metro Atlanta. And our sole focus is doing real estate closings. We do a little bit of this, that, and the other, but 96% of what we do is doing real estate closings. Along the way, we asked real estate agents, what can I do for you that's really helpful, really valuable, really meaningful? I said, I can hand out pens and paper tablets and stress balls and all the little toys and tchotchkes. But we said, what do you really want? And you know what agents always told us? They said, you know what we really need, what's really important are CE classes. Richard and I formed a school approved by the Georgia Real Estate Commission, allowed us to teach CE classes. Additionally, I became an approved instructor with the Georgia Real Estate Academy, and our class today is taught through the Georgia Real Estate Academy. Teaching CE classes is a way that I volunteer and help give back to the real estate community that we serve. So that's a little overview of who I am and where I came from. They say that every speaker should begin his presentation with a joke. So I use the same joke that I use at the closing table, and that is that my brother and I do the same thing for a living. We both put people to sleep. The only difference is he's an anesthesiologist. He's got heavy narcotics. I have boring material and a soothing voice, but I will do my best to keep your attention, make it fun and exciting, and try to keep you from letting me lull you off to sleep. So without further ado, I'm going to go ahead and jump into our course materials. Bear with me just one moment while I share my screen, and I've got some information that will be helpful to us.
We can see your screen, Doug.
That's fantastic. I'm just going to put it in full screen mode. Actually, I'm not, because I don't know how to zoom back in. I'm going to do it like that. Thank you, Dana. Our class today, called Show Me the Money and Get Me to Closing. Let's start with the course description. A couple of things I want to cover with you are basic concepts about the mortgage process and the closing process. I'll tell you that this all took on new light to me because my 23-year-old son is buying his first home. So I have been walking him through the mortgage process in a way that's been different than the 9,000 closings I've done over 20 years. So I've done it myself, but that was different. I helped a novice first-time buyer walk him through the mortgage process. So I now have a new perspective on it. The mortgage process and the closing process. I want to help real estate agents understand how the process of getting the loan from loan application through appraisal and to the closing. We're going to cover different types of loans, how to effectively complete a contract for a purchase and sale, and seller's contributions, financing contingency, and we're going to talk a little bit about the closing process, the role of the attorney. We're going to look at title issues, types of deeds, and documents that the buyer and seller sign at closing. And understanding the CD, or closing disclosure. Our objective, I want to give you a basic yet thorough understanding of the loan process and the closing process. I want you to be able to help facilitate communication between your buyer and your lender. In our business, it all starts with communication. No matter how well everything else is done, the failure to communicate will ultimately cause problems. So facilitating the communication between the buyer and the lender is critical. Understanding your seller's mortgage payoff, and also preparing your buyer and seller for the closing process. I'd like you to be able to prepare a buyer cash to close estimate and a seller's net sheet estimate, and be able to interpret the closing disclosures to your buyer and seller. And it is a 3-hour class. A little word first on the actual mortgage process. What's happening when your buyer is going through getting this mountain of data over to your lender? Well, the first thing that you'll want your buyer to do is apply with the lender and get pre-qualified. In a pre-qualification, your buyer gets a few key pieces of information to the lender so that the lender can make a preliminary determination on what type of loan they would be eligible for and about how much money they would be able to borrow. Key things that a lender will look at to do that are things like the buyer's income and an estimate of some of the buyer's debts. All loans have what's called a maximum percentage of their income that they can borrow against. So with just a few key pieces of information, your lender can pre-qualify your borrower and give them an idea of about how much money they'd be able to borrow based on their unique circumstances. Remember, this is a qualification. This is not an approval. They do not pull credit to do a pre-qualification. They haven't approved anything. They've just said, if you tell me that you make $5,000 a month, and what type of, do you have a lot of student loan debt that might limit your loan? They'd say, I think you'd be able to qualify for a loan up to 250,000 or 300,000 or whatever. That's the pre-qualification stage. Now, to process a loan, stepping back, remember that lenders make loans, and a loan is a product. Just like anyone else who makes a good or service, the lender's goods and services is a loan. And they make a loan with the intent that they want to be able to sell it. My thought is, why would you ever want to make a product that you can't sell? So lenders, in order to make loans sellable in the secondary market, lenders use common criteria, what I call a box. They want to show that this lender meets all of the criteria to fit in the box. So if the lender later wants to sell the loan to any other entity, whether it's Fannie, Freddie, or another lender, and they say, well, tell me about this loan, and they say, well, there's not much to tell. It fit in the box. It met all the standard criteria for this type of loan. And they say, oh, okay, I know exactly what I'm buying because you qualified it according to these standard parameters. Now, we're going to talk about the different types of loan a little bit later in the class, things like conventional and FHA and VA and the like. But there are actually hundreds of types of loans. Within an FHA loan, there are all these subcategories, and they're more or less invisible to you, me, and your borrower. But there are, within FHA or conventional, lots of different types of loans. So they have a lot of different boxes that they can put the loan in. And what that means is they want to show that the loan met standard criteria, so they have a loan that someone else would want to buy. And that involves things like credit scores, the maximum debt ratios, appraised values, percentage of loan value, how much the borrower puts down. All these criteria go into making sort of a loan fit within the target, within the box. And that is what processing is all about. They want to get enough data to say this loan matches all the standard criteria for that loan. And that's going to be things like bank statements, pay stubs, credit report data, appraisal, the contract, so on and so forth. Now, once the loan officer and the processor have gathered all of this information in processing, they don't get to approve the loan. They gather this data and they say, I want to make this type of conventional loan. Here's all of my data. And here's why I think this data fits into the box for that loan. They take that data to a person at their company called an underwriter. The underwriter.
Doug, I'm going to interrupt you for a second. We are still just seeing that first slide with the course description.
You know, it says my screen sharing is paused. I don't know what's happened to it. How do I, let's see. I'm going to stop share and then try to share it again, or resume share. Here we go. Do you see it now?
There we go. We just need the outline. Yes.
Yes. We're on the course outline under mortgage process. We've talked about pre-qualification. We talked about the data that goes in for processing. And then we were saying once the loan officer and their processor have accumulated all this data, they give it to an underwriter at the lender. The underwriter's job is to take all the data, evaluate the parameters for the type of loan that the loan officer is trying to place it with. And the underwriter basically has three options: yes, no, or get me more data. They can look at it and say, yes, good job, loan officer and processor. You have compiled all of the data necessary to show that this loan meets the standard criteria. Or they can say, no, I think you have made a mistake. There is something something in this that says this loan does not meet this criteria, we won't be able to do that type of loan. Now, that doesn't mean it's a denial. Remember that I mentioned that within each type of loan, like a conventional and an FHA, there are hundreds of subcategories. They might be able to go back and get a different category within FHA. For example, you can have an FHA loan with a minimum of 3.5% down, but you might get different criteria to approve your FHA loan if you put more down. So maybe the loan officer and the processor take it to the underwriter and they say it doesn't quite meet these criteria. But if we get 5% down instead of 3.5%, there's a different type of FHA loan, and I think we can put it in that box. So that's what the underwriter's job is. Review what the loan officer and the processor, the data they provided, determine does it meet our standard criteria to make this type of loan, and then they give those folks the direction, yes, good job, it's approved. No, this doesn't work, or I need a little more information. I see that we're using gift funds. You need to go back and get a gift letter and a couple more steps that you need to take. So that's what the underwriting is doing. The other thing that's happening as part of this process is the appraisal. Lenders are loaning money with the intent that the property secures the loan. If the loan isn't repaid, they can retake the property, sell the property, and get their money back. So that's what protects lenders, is having security in property. That makes sense, and that's all well and good. But how much is the property worth? So the lenders order this an appraisal to determine how much they're willing to loan. And typically, that's going to be a percentage of the appraised value of the property. The other thing is they're putting together this loan package. They're documenting all of this to say, yes, we now have all the data that we need, and we are ready to go with your loan. We've documented all of this data, your income, your credit, your the value of the property and your asset, and we're comfortable making the loan. The mortgage players, who all is involved in your buyer getting a loan? I've spoken a little bit first about the originator. The originator is the person who's tasked with working with your borrower, analyzing the data that they provide, and determining what type of loan he can offer that will fit their requirements. For example, is this a young buyer that wants to put a minimum amount down, or is this someone who maybe has proceeds from another sale and they'll be able to put more than 20% down? So they want a different type of loan. They don't want mortgage insurance. They have more money to put down. So the loan originator is the person who's versed in all the different types of loans that the lender can offer and knows the criteria to make each loan and is able to evaluate your borrower's needs and determine what loan is the best fit for what they want to do. Now, helping the originator, as we know, I'm sure you've seen working with your borrowers, there is a mountain of paperwork that goes into getting your loan approved. The loan processor works with the originator and helps them process all the paperwork. So your borrower might start with the originator to get the loan process moving, but the originator will get the process going. The processor will work with your borrower to help pull all the information, to let them know what they've received and what they need and so forth. So that's the processor's role in the transaction. The loan underwriter has the job to take that data, evaluate it, determine if it fits against the criteria that the loan originator thinks that he's demonstrating compliance to. And then the loan underwriter is going to do one of those three things. Say yes.
Excuse me, Doug, if you'll go into manage participants and click mute all, please, that would be wonderful.
Thank you. All right, thank you, Dana. So the underwriter has those three jobs, or those jobs to evaluate the data, determine that it meets the criteria of the loan that the loan originator selected, and then go back to the originator and processor with the thumbs up, the thumbs down, or the we need more information. You'll remember that when I spoke earlier, that lenders like to make loans using specific industry-wide criteria. And a lot of those criteria are set by what we call the GSEs, that's the government-sponsored entities, things like Fannie Mae and Freddie Mac. And when you make a loan and you say, I have complied with Fannie Mae or Freddie Mac requirements, every other lender knows exactly the parameters of that loan. So they sort of set out the specifications so that loans are made with fairly consistent criteria. And that enables loans to be bought and sold, which I'd mentioned is important. One question I get is, why is it important for lenders to be able to buy and sell loans? And one answer I give is, if you are a lender, it doesn't matter how much money you have, you will eventually run out by making loans that take 30 years to get repaid. So lenders make loans, they sell them to investors that want to collect the interest, and that frees up capital so they have more money to keep making new loans. So the actual buying and selling of loans is what creates money flow. If you're, like I said, if you're a lender and you keep making loans at 250,000 a pop, and you're waiting months, you know, you're getting a fraction of it every month for 30 years, you're going to run out of money in your loan pool. So you sell loans, which frees up capital to make new loans. And conceptually, that's what's going on behind the scenes for the flow of money. Now, we had spoken about Fannie Mae and Freddie Mac. They have standard criteria that most all lenders use. The other government entity is FHA. FHA has their own loan criteria as well, as does the VA, the USDA. Now, when we talk about USDA loans, you'll hear them called rural loans, which is really something of a misnomer. You'd be surprised when you look at the USDA maps. As Metro Atlanta has grown larger and larger, there are places that you don't think of as rural that actually might be qualify for a USDA loan. And I'm going to go into more detail about each of these loans. I just want to give you the high level overview of what what the loan types are. And then we'll also talk a little bit about down payment assistance. So what is a conventional loan? A conventional loan is a loan that meets Fannie Mae or Freddie Mac standard requirements for borrowers' income, loan to value, what percentage of the value they can borrow, their debt to income ratios, all of these criteria that go into determining if the loan meets the specific parameters. Another thing about conventional loans is we can have conventional loans with mortgage insurance and conventional loans without mortgage insurance. The idea here is that lenders don't want to loan against 100% of the value of the property. One, they want the buyer to be invested in the property. They want the borrower to put some of their own money, or what we call skin in the game. They want to know that the buyer has a stake in this property. The other reason is if the buyer takes the property back through foreclosure, rarely are they able to sell it for market value. So they're going to be selling it for some fraction of market value, and they want to minimize how much money they would lose. And customarily, that dividing line is 80%. They will loan 80% of the appraised value of the property and not require mortgage insurance. So, what exactly is mortgage insurance? The concept of mortgage insurance is the lender says, I'm willing to loan more than 80% of the value on one condition. And the condition is that you pay for some insurance called mortgage insurance. And in the event I have to foreclose on the property and I sell it and get less than my loan amount, the mortgage insurance company will reimburse me, the lender, for my difference. And so sometimes people say, well, I don't like mortgage insurance. And I tell them it's a two-edged sword. The advantage to mortgage insurance is that it lets the lender make a loan they wouldn't want to make if they didn't have insurance. The trade-off is, well, if you don't want mortgage insurance, put 20% down. And you say, but I'd like this house and I don't have 20% down. And the lender says, that's fine. I'll loan up to 90 or 95%, but you just need to pay a little extra for mortgage insurance to cover my loss if you don't pay on the loan. To the lender, that's a more risky loan. The borrower has less invested, and there's less room for the lender to get their money back if they have to foreclose and retake the property. So, like I said, it cuts both ways. Nobody wants to pay extra for mortgage insurance, but on the flip side, I'd rather borrow more money and get a nicer house and put less of my own money down. And the trade-off is, yes, I have to pay some mortgage insurance. Now, you'll also hear that mortgage insurance, that you can, quote, make mortgage insurance go away. There are two things to consider there. In a conventional loan, mortgage insurance will automatically drop off when the borrower has paid the loan down to 80%. The lender thinks at 80%, there's enough equity in the property. If they have to foreclose, they won't lose money. So on a conventional, the mortgage insurance will automatically drop off at 80%. The borrower can ask the lender to drop mortgage insurance sooner if the borrower does four things: give them a written request, have a good payment history, be current on their payments, and show the lender that the amount they owe is now 80% or less of the appraised value. Perhaps they've paid ahead on the loan, they've paid down on it, so they paid it down to 80% quicker than what was originally forecasted. And they say, look, I've already paid it to 80%. Will you drop the mortgage insurance? And the answer is yes, the lender can do that with those criteria. Hold that thought for a moment. I'm getting ahead of myself. FHA also has mortgage insurance. It will go down a little bit every year, but it never drops off. And you can't ask the lender, can I drop my mortgage insurance on an FHA loan? And the answer is no. Mortgage insurance on an FHA will run the life of the loan. One option to get rid of mortgage insurance on an FHA loan is simply to refi it with a different type of loan and get rid of mortgage insurance in that way. So it's important to remember there are two types of mortgage insurance. The mortgage insurance for a conventional loan is called PMI, or private mortgage insurance. That's done actually by insurance companies for lenders, private companies. That's why it's called private mortgage insurance. And those criteria for how the mortgage insurance works are fairly standard. For FHA, VA, well, for FHA, the mortgage insurance is provided by the federal government, by FHA, and it works differently than PMI. It's actually called MIP, Mortgage Insurance Premium. So they actually have different names and different acronyms. VA insurance is actually guaranteed by the Veterans Administration, and USDA is guaranteed by the U.S. Department of Agriculture. So there are four different insuring bodies for each of those types of loans. So let me just recap real quickly about a conventional loan. A conventional loan means the lender will use criteria set by Fannie Mae and Freddie Mac to evaluate the loan application. make sure that all the data about the borrower and the property meet those criteria. A conventional loan may have mortgage insurance or PMI if the loan value, the loan to value exceeds 80%. That PMI can drop off once the borrower has paid it down to 80%, which can happen automatically, and the borrower can request that it be done sooner if they meet certain criteria. So moving on to an FHA loan. An FHA loan, how is it similar to a conventional? How is it different? Well, it's similar in that customarily both are 30-year loans. Interest rates are not dramatically different. They're within the same band. But the key difference with an FHA is that the mortgage insurance is set by the FHA, the Federal Housing Administration. So it is priced differently than a conventional, and it works differently. The other reason that a lot of times people will go with FHA is that the lending requirements can be more flexible with an FHA than with a conventional loan. With a conventional loan, we have private insurers for PMI, and the goal there is all of these stakeholders are trying to make money. Mortgage insurance is trying to make sure they pay less in claims than they take in premiums. Lenders are trying to make sure they make loans that will be repaid according to their terms, not result in defaults, not result in them taking property back and selling it less than it's owned. FHA is a government-sponsored loan, and so their goal is not profit. Their goal is to help people buy homes. So that's one of the key differences between an FHA and a conventional loan. And because of that, the mortgage insurance works differently. On a conventional loan, the mortgage insurance typically is just a flat monthly fee for the time until it's paid down to 80%. FHA has two components to mortgage insurance. The first one, called UFMIP, is the upfront mortgage insurance premium. That's sort of the down payment on the mortgage insurance, if you will. And then there's also a monthly component to the mortgage insurance.
Doug, we have a question. Is there any mortgage insurance paid by a buyer for a USDA loan?
There is, and I'm trying to remember exactly what the criteria are. It is less than an FHA, but there is a mortgage insurance component to it. Now that upfront mortgage insurance on the FHA is financed back into the mortgage. You borrow enough that it covers that, and then you make the monthly payments. Remember I talked about conventional loans use criteria set by Fannie Mae, Freddie Mac. FHA loans use loan criteria set by FHA. And those loan criteria, because their goal is not profit like a conventional loan, it's to help people buy homes, it means their standards tend to be a little more relaxed. While a borrower might not qualify for a conventional loan, they might be able to qualify for an FHA loan. I'd mentioned to you earlier, and I'm going to use it a couple of times as a good example, that I'm helping my son buy his first property, and he's getting an FHA loan. The answer is he can put a little less money down. He doesn't have a lot of credit yet, so his credit score is lower. So there are a lot of reasons that the lender can make his loan fit inside the FHA box easier than they could make it fit inside of the conventional loan box. And that's the idea with an FHA loan. We're trying to help people buy homes. We have a little lower credit standards, a little lower down payment requirements and things like that. Now, there are two types of FHA loans, the traditional FHA or HUD insured FHA loan. An FHA 203K loan is what we call a rehab loan. Your buyer wants to buy property, but it's distressed, it needs work, and your borrower doesn't have the money to fix it up. The FHA 203K loan allows them to borrow and roll in their refinance costs. It's all set up front, and they can find, they set up what repairs will be done, they select contractors, they get estimates, and they roll it all into their loan. Another thing we're going to talk about in a minute that's common to all loans is the payment. The payment consists of what we call amortized. That means if I tell you you want to borrow $100,000 for 30 years, 360 payments at 3% interest, we compute the payment and say this is your payment for principal and interest. On top of that, the lenders might require an escrow account for taxes and insurance. The way they set up the escrow account, they set up the escrow account to what they want to do is they want to collect enough to pay taxes and insurance as they're due and have 2 months reserves at the low point during the year. They don't want the escrow to go all the way to zero. They want a 2-month cushion in case the taxes and insurance run higher. So you'll hear that expression PITI. The P and I is the principal and interest on the loan, T for taxes, I for insurance. And the fifth component to that is going to be the cost for the monthly cost for the mortgage insurance. So we've spoken a little bit about the FHA loan, about how HUD insures it, how the criteria can be a little different than a conventional loan, and that the 203K was a rehab type loan. So what's a VA loan? A VA loan is similar. It has a lot of the similar components to an FHA loan. Key differences: a VA loan is only offered to active and honorably discharged members of veterans. The other difference about it is a VA loan does not have a monthly mortgage insurance cost. It has a one-time upfront fee called the VA funding fee. So for a VA loan, they only pay for the mortgage insurance one time, it's paid up front, and it's rolled into the loan. Other than that, the VA and the FHA loan are fairly similar. Similar underwriting criteria, the fact that you can borrow a higher percentage of the property value with a VA loan than you could with a conventional, things like that. The USDA loan is, again, similar to an FHA. It was originally designed, it was called a rural development loan, and it was to enable people to buy property in what were considered rural areas. And the interesting thing is, as our city metropolises have grown, there are areas that you wouldn't think of as rural that are now included in the USDA loan. One of the key differences with a USDA loan is that the underwriting may be a bit more strict than an FHA, but the trade-off is the cost of mortgage insurance is actually, I believe, less than on an FHA loan. The down payment assistance programs, when you have a borrower that needs help getting into the program. Now, these were very popular 10 years ago. They actually, to some degree, fell out of favor. Lenders felt like they were not always being used in a fair and honorable manner, but they were sometimes used to get people into houses that they really couldn't afford. So a lot of the down payment assistance has been removed. There are still a lot of the down payment assistance programs available today are offered by municipalities, whether it's city or county housing authorities, and they'll have specific criteria, whether it's income or location and so forth, that will allow them to contribute down payment assistance to help a borrower who's struggling to get their down payment money together. I'm going to take a pause for a moment because I've been speaking for a good bit, and it's different in a virtual class. In a real class, I can see everybody a little better. I can kind of see if everybody's with me. Dana, do we have any questions so far?
FHA upfront mortgage insurance, what is the percentage and what is the percentage monthly?
I'll be honest and say I don't have those percentages committed to memory. Lenders do because they work with those figures all the time. And I don't want to guess, but it's something like 1 and a fraction for the upfront mortgage insurance, and I forget what the percentage is, and the monthly is something like 0.3% of the loan amount. I'm actually trying to Google it for you in case you're curious, if you're looking at my face and say, what is he doing? I don't know those percentages off the top of my head, but they are flat numbers for the upfront and for the monthly.
Can you please touch base on the subject of an ARM loan, adjustable rate mortgage loan?
Yes, thank you for asking the question. We've been talking about all these types of loans, and within each type, conventional, FHA, and so forth, there are both fixed rate and adjustable rate. Because interest rates are at historically low levels, I'm just not seeing a lot of variable rate loans right now. As a matter of fact, I haven't seen one in a long while. Most everyone has taken a fixed rate loan. And you say, okay, talk me through it. Why would somebody want an adjustable rate mortgage? The reason that a lender can make an adjustable rate mortgage is they know they're not going to be locked into that interest rate, but the interest rate will fluctuate with the market over the life of the loan. The trade-off for that with an adjustable rate mortgage, allows the lender to have a lower starting interest rate because they know that rate will change over time with the market. And so for a buyer who's buying a home, knowing that he does not expect to be there for a long time, I'm going to be in this city for 3 years, but I don't think I'm going to stay here. So I don't want to get a fixed 30-year loan. I could get a lower interest rate on an adjustable rate mortgage. And he says, and that makes more sense to me because I'm going to sell it or refinance it before my rate changes. Now, the criteria to underwrite the loan are similar, but remember, since the lender can offer a lower rate upfront on the adjustable rate, that can help a borrower who maybe has less income, help them with their debt to income ratio because it will make their payment lower. Now, the two things to know about an adjustable rate mortgage, actually 3 things. First, what is the starting interest rate and how does it compare to a conventional loan? The second thing is how long is that rate fixed for? And third is how often will the interest rate change and what is the change tied to? You'll hear, most ARMs, you'll hear a section of numbers like a 5-1 or 7-1 or things like that. And what that means, the first digit means how long is the interest rate fixed? It'll be fixed for 5 years, and then it will adjust every year thereafter. And in most cases, they adjust based on one of 2 common indexes. One is what's called the prime rate in the Wall Street Journal, or prime rate. The other one, for a long time, they used a money rate that banks use to loan money between each other called the LIBOR, or London Interbank Offered Rate. And the LIBOR was a sort of a standard computed interest rate, and it was used for a lot of adjustable rates. But the LIBOR is actually going away. Whoever determines the LIBOR rate, that rate's going away. So they've substituted it with a similar metric for what rate do banks charge each other for interest. So again, key things to know about an adjustable rate is typically you will get a lower initial interest rate than with a fixed rate loan. It will change at some point on that date and every periodically so thereafter. The other thing to know about an adjustable rate are what are the caps? In other words, the first time it changes, what's the highest it can go to? And every year thereafter, how much will it change from the year before? And I'm just going to make up some numbers. Let's say you can get 2.75 on a fixed rate today. And maybe the lender says, well, I can give you 2% on an adjustable rate. It will change in 5 years on that date and every year thereafter. It will change based on the prime rate in the Wall Street Journal. And the first time it changes, it will not go more than 8% or less than 2%. And every year thereafter, it will not change more than 2% from the time before. So they can give you all of these parameters. It's important for your borrower to understand, wow, 2% for 5 years sounds great. And you say, okay, what will the interest rate be in 5 years? We don't know. What could it be? Well, it could be 8% or whatever the number is. And you need to look at what would your payment look like in 5 years if the interest rate went up to 8%, because they will not only adjust the rate, they'll adjust the payment because they're still going to pay it off in 30 years. So that's the other consideration with an adjustable rate. Dana, any other additional questions so far?
That is all that I see in the chat right now.
Great. Either that means I'm doing a good job explaining it or I put everyone to sleep.
I will just add a broker perspective for the contracts. If you guys are, I am also the broker of Maximum One Greater Atlanta Realtors. So that's my background for this comment. If you are working with a buyer who is getting any sort of down payment assistance, whether it be from Georgia Dream or any of the other programs out there that do offer down payment assistance, if you are working with a buyer and that is where their down payment is coming from, you must make the contract subject to or contingent upon the buyer receiving those funds. And the reason I say that is if a buyer is doing that and you do not address that in the contract and get the seller to agree on that contingency, if a buyer for whatever reason does not get those down payment assistance funds and they terminate the contract under the financing contingency, that buyer's earnest money is not protected. It specifically spells out that a loan, if a buyer's going to terminate under a financing contingency, the loan denial letter, the loan may not be denied for the reason of the buyer not having their down payment money. So that is a separate contingency that a seller must agree to in a contract. Please get with your broker for the verbiage of how to write up that contingency as a special stipulation. But just because they don't get their down payment assistance funds, they're not going to get their loan and they're going to lose their earnest money and they're not going to be happy with you. So please make sure you buyer's agents to protect your buyers contractually if they are getting DPA funds. Back to you, Doug.
Just real quickly on that point, Dana, to the best of my knowledge, there is not a GAR special stip pre-written for down payment assistance, or is there? I know you mentioned getting with your broker to get something.
Correct.
There's not a GAR special stip addressing down payment assistance.
No, I am not aware of a special stipulation in the GAR special stipulation index library or in the RE forms index library. We have one at Maximum One that a closing attorney has written for us back in the past, and I will type that in the chat. So I will type that in the chat. You guys, when you see it come across the chat, either write it down or take a screenshot of it. If you are, please, for any special stipulations or anything you add to a contract, just a reminder, you must get permission from your own broker prior to adding any special stipulations that do not come from the GAR library or the RE forms library, or that have not come directly from your broker. So I'll type in that verbiage in the chat.
All right, thank you, Dana. And
Thanks, Doug.
Dana, on the next section, because I know that you have a different perspective, me as a closing attorney and you as a broker, the next section, we're talking about the lender and the real estate agent. So uh, please feel free. I will not be at all offended. In fact, delighted. If you have a different perspective on some of this topic, which is lender and agent, feel free to speak out if there's anything you'd like to add. Just
Okay.
wanted to make sure that I'm totally fine with it. So the next section we want to talk about is the lender and the real estate agent. Now, bear in mind, we've got different responsibilities here. We've got agents with their client or customer, and then we've got lenders with their client or customer, the borrower. So we've got this relationship between your borrower and your lender. And you want to be a part of this for several reasons. One, you want to make sure it's getting done. Two, if there are issues, you want to help solve it. But at the same time, the buyer has this responsibility to provide to the lender the information that they need. And you really don't want to be the middleman in this transaction. You want your buyer working directly with your lender, and you want to be their assistant, provide guidance, provide counsel. You also want to be able to speak to the lender and find out how is it going? Are there issues? Are there problems? And I'm not sure, I think both GAR and RE forms give you some limited authority to speak to the lender, but there are some things the lender can only discuss with their borrower. Again, remember your role is to help sell homes and help point your buyer in the right direction to get the loan. The buyer's job is to work with their lender and get the lender the information they need to get their financing. And you need to be there as a resource to assist your buyer in that regard. Similarly, if you're a listing agent, you're representing the seller, and there is information that the lender might need to underwrite the loan that they're going to need to get from you as the listing agent and the seller. For example, one of the first things is we're going to want to do an appraisal. The lender is going to need to reach out to you as the listing agent and to the seller, schedule a time to do that. So just as the listing agent, there are certain things you should know and be expecting and be ready to cooperate and help the lender get what they need to process your buyer's loan. Also, the agent is facilitator between the borrower and the lender. Remember that to me, there are these what I call lines of demarcation. Everybody in this transaction has a role to play. They have a specific task that they need to do. Your borrower has specific tasks to do, as does your lender, and your goal is to help your borrower, but not do it for them. Not your job to start helping them pull their bank statements. It's like you need to get to your lender these things. Then if the lender asks for property data, you want to be able to help your borrower get the information that the lender is asking your borrower for. The other thing where you're really an asset to your buyer in getting their loan is writing the contract. When you're working with your buyer, you know what your buyer's expectations are. About how much money do they plan to put down? What type of loan are they looking for? And in evaluating the offer that you want to make to the seller, one thing you can ask for is your seller's contribution to your buyer's closing costs. And again, on the one hand, that will help your buyer get a loan and get your transaction closed. But on the other hand, it will especially in today's market, which has been extremely hot, multiple offers, and your sellers are going to be looking for the best offer that they can get, which isn't necessarily the highest sales price. The highest sales price, they might want more contributions to buyers' closing costs. So whether you're the listing agent or selling agent, You need to be looking at each of these and rolling them together and say, what is the net effect? What makes the best offer? And what is actually needed? Back to the example for my son, who's actually closing tomorrow. He was a first-time home buyer. He didn't have a lot of money to put down. Um, so that was one of the things they made in their offer is they were willing to negotiate on their sales price, but to negotiate in a way where they could get seller's contribution towards buyer's closing costs. So just taking each of these items together. The other important thing to think about is your buyer is not a cash buyer. They need to get financing, is understanding your financing contingencies. Conceptually, the idea with a financing contingency is your buyer and seller say, I want to buy and you want to sell. But the buyer says, but I only want to buy if I can get the type of loan I want to get. And the seller says, well, I don't want to take this thing off the market forever. What do you want? And the buyer says, well, how about this? How about if you give me 20 days to determine if I can get the loan for this property? And if I do, that's great and I'll move forward. And if I don't, I'll say, I'm sorry, I can't get the loan. I'm not going to buy the property and I want my earnest money back. And the seller says, that seems reasonable. That's fair. Let's draw that up. That's what the financing contingency is doing. Its intent is to say, I want to buy, I want to sell. I only want to buy if I can get the financing. How long do you want? I want this many days. The other thing we need to spell out in the financing is, remember I mentioned there's 4 families of loans: conventional, FHA, VA, USDA, but there are actually hundreds of types of loans within each category. So we need to spell out what parameter of loan would be acceptable to you as the buyer. And the buyer says, well, I want no more than 3% interest on a 30-year fixed rate, this, that, and the other. And you say, okay, let's put all these criteria in our financing contingency. And typically, if you're using whether GAR or RE forms, we've got standard fill in the blanks where we're capturing all of this data. How long does the buyer have to find out whether or not he can get financed? What are the loan terms the buyer is willing to say are acceptable for his financing? And what does the buyer have to do if he doesn't get his financing? Customarily, the way it's handled is the other thing in this back and forth between our buyer and seller about getting financing is the buyer says, I want to apply for a loan, and the seller says, I understand, but let's put a specific lender in the financing contingency. I know this lender, I know they're good, and if they tell me you can't get the loan, then I know you really can't get the loan. And if that's the case, your buyer can apply to any lender that they want, but they must apply to the lender listed in the financing contingency. And the only letter denying their loan that will matter is by the lender that's listed in the financing contingency. If no lender is listed in the financing contingency, then a loan denial letter from any lender licensed in Georgia is acceptable to meet the financing contingency. Now, if you're a selling agent working with a buyer, one thing that you'll hear me say is that contracts are big boy, big girl stuff. These are legally binding contracts that have ramifications to the parties. If it says apply within 3 days after the binding agreement date, make sure your borrower applies within 3 days after the binding agreement date. It says, unless you tell the seller within whatever, fill in the blank, 15, 20, 25 days, unless you tell me within that time period that you can't get the loan, then the financing contingency no longer protects you. So make sure that your buyers know these deadlines and say, all right, we put 20 days in there. We're coming up on 20 days. Do we have a loan approval or not? And we have to get a determination as to whether or not you're going to get the loan. If you give the seller notice, that you're unable to get the loan and you want to get out of the contract based on the financing contingency, you're also going to have to provide them a loan denial letter that says this person really did apply for the loan. We gave it careful consideration, and he's not going to be able to get the loan on the terms that he's requested. The other thing to know is, what is the reason why? In the GAR form financing contingency, it says if you don't get the loan, and the reason you don't get the loan is solely due to something within your control or something you did wrong, then you're not covered. If you didn't timely give the lender the data they needed to process the loan, and they say, well, we denied his loan because he never gave us bank statements and tax returns. The financing contingency is not going to cover him for that. Or if they say, we could have given him the loan, but he went out and charged a bunch of stuff recently and has ruined his credit, or his available credit and so forth, the contingency doesn't cover. Dana mentioned earlier, well, I applied for a loan that said 20% down, but I don't really have 20% down, and that's the reason I can't get my finance contingency. And the seller says, I'm sorry, that's not covered. You said you wanted an 80% loan. We assume you have 20% down. If that's the only reason you can't get the loan, you're not covered. So again, be aware of all of the deadlines for each thing that has to happen in the financing contingency, and be aware what's not covered in the financing contingency. Another item not covered in the GAR contract financing contingency is if the loan is denied due to failure to sell or lease another property. In other words, you can't get this one because you haven't sold your other property. If, in fact, your sale is contingent on another sale, there's another contingency document that you need to use. You're not covered by the financing contingency, but if you have another exhibit amendment to the contract that says this sale is contingent upon me selling or leasing this other property, that's where it's addressed. It isn't addressed in the financing. So handling appraisal issues. We've got our lenders determining, will this loan fit within the box? And they do that by determining how much the property is worth, and they come back with a low appraisal. The GAR contract handles appraisal issues in a couple of ways. The buyer can say, I want to get out of the contract because the property did not appraise. They can do that. However, the seller has the option in the GAR contract to say, I will automatically lower the price to the appraised value, and you are still locked under this contract. In other words, you can't get out because it appraised low, because I was willing to reduce the sales price to the appraised value. So each party has some leeway. The other option is the seller can say, I won't reduce the price. If you want to walk, walk. And the buyer says, that's okay. I'll waive the appraisal contingency. I'll just pay the difference out of my own pocket. In other words, I'll keep it at the same purchase price, and I'll pay the difference. So each of them have some options if the property does not appraise. The other thing that's going to happen is the lender is going to start to put a loan package together for the closing. They're going to start to determine what documents does the borrower need to sign, what needs to be provided at closing, what are sort of the open things that the lender requires to make this loan a reality. For example, the only loan program that currently requires a clear termite letter is a VA loan. If your borrower is applying for a VA loan, one of the loan requirements is going to be there's a clear termite letter. So be aware of that. Now, of course, you might have in your contract special stipulations that the seller to provide a termite bond or a clear termite letter. Those would be contractual items. but just be aware of anything specific that your lender requires. For example, the termite on a VA loan. So where would we be without government involvement in what we do?
Doug,
Housing.
I'm going to make a couple of broker comments on the appraisal and financing contingency before you move on.
Thank you.
So just a couple of things. Make sure you understand that if you are working with a buyer, and even if you are on the listing side, if a buyer is terminating under the financing contingency period, as Doug said, they must send notice of that termination to the seller prior to the agreed upon time frame, contingency time frame, and they must prove it. Now, in the GAR contract, they have to send notice before the end of that contingency period, and then they have 7 days to provide the loan denial letter. If the parties are binding under the RE forms contract, they must send the loan denial letter simultaneously with the notice to terminate under financing contingency prior to the end of that deadline. If you are binding under any other contract, new construction, HUD, so forth and so on, you need to read through the contract and find out all the terms of protecting a buyer under a financing contingency or any contingency. But regarding GAR and RE, it is spelled out in both of those contract forms. Like Doug said, there are very, very specific reasons that the loan must be denied in order to protect the buyer's earnest money should they terminate based on the financing contingency. One of the biggest things is the down payment, and closing costs. Make sure you understand that. The other thing is this generic phrase that says anything not caused by the buyer. And so what that means is when you agents are working with your buyers, especially around the holidays, Labor Day, Memorial Day, Christmas, Thanksgiving, any and every holiday, when your buyers start seeing these advertisements, furniture, same as cash, anything like that, that is not same as cash. They are going to, if they purchase a whole house full of furniture under one of those programs, it is going to impact their credit. If they buy a new car, it's going to impact their credit. If the buyer's activity, i.e. buying something, so forth and so on, changes their credit picture, their debt to income ratio, shows something wonky in their bank account that the lender doesn't like, anything, that is the buyer's activity that has now changed the loan. If that's the reason for the loan denial, they are also going to lose their earnest money. Their earnest money is not protected on that. So wanted to make sure that you are aware of that. And also the loan that is denied in the loan denial letter must be the loan that the seller agreed the contract was contingent upon. In other words, the loan denial letter, the loan that's denied on that, must match the terms on that financing contingency that you wrote. The interest rate, the down payment, the length of time, so forth and so on. So there's nothing that prevents a buyer for seeking any type of loan to purchase a house. But in order to protect their earnest money, if they terminate, that loan denial letter must be the loan that was agreed upon in the contract. The other thing that I want to let you know, and I just did a video on this, is new this year in the GAR purchase and sale agreement. If a buyer and seller go under contract with the buyer getting or making it contingent upon them getting a conventional loan, if a buyer changes and wants to go get an FHA or VA or USDA insured loan, government insured loan, they cannot do that. If they're binding under GAR, they must amend the contract and get the seller's written permission for them to seek one of those loans. And you're like, well, why? The loan is no business of the seller. In one of these government insured loans, it absolutely is, because in FHA, VA, and I believe USDA, there are seller incurred fees that are not otherwise incurred by a seller under a conventional loan. And an FHA or VA appraisal sticks with the seller's property for 4 months, where a conventional loan doesn't. So if parties are binding under the GAR contract, conventional loan, buyer switches, you must amend the contract to that effect, and the seller does not have to give permission to a buyer to get an FHA or VA or USDA loan. So I just wanted to bring your attention to those specific contractual issues regarding this. And just one more comment on the appraisal. If an appraisal comes in subject to repairs, because we're having a lot of questions like this, like the appraisal will come in and the sale price on the appraisal value meets the sale price on the contract. However, on the appraisal, it is subject to repairs. And this is in FHA, VA, and conventionals. Not a lot of conventionals, but conventionals where the buyer is getting their loan from one of the bigger banks. That still, it has to do with an appraisal contingency, because it's only valued at this price as long as these repairs are complete. So those kinds of issues fall under the appraisal contingency instructions in your contracts, not the financing contingency. They're not going to get financed, but as far as protection for the buyers and termination and processes and procedures to work through that, that would fall under the appraisal contingency part of the contract. And for an FHA and VA loan, under the amendatory clause section in the contract, and not the financing contract. Those were my only brokerage comments. Let's see. So do they need permission to switch even if there's no additional charge to the seller? Well, there is an additional charge to the seller. In an FHA and VA loan, there are fees the seller is required to pay. Now, you might be asking, well, there's no additional fees because the seller's already making a contribution to closing costs. It doesn't matter. The like tax certification fee, so forth and so on. But yes, you absolutely need to get permission. Number one, it's part of the contract that the buyer and seller agree to. And number two, that appraisal will stick with the property, and a seller may not want an FHA or VA appraisal attached to their property address. So yes, it is a question of that is in the contract that the buyer and the seller agreed to.
Dana, those are great points. Thanks for mentioning that. The two things I wanted to add to that you've touched on. One is that FHA and VA, more so than conventional, can require repairs, and a well-drafted financing contingency will address that, and will come back and say, if the lender requires repairs, the seller agrees to pay up to whatever dollar figure, which could be zero, towards repairs. And then it goes on to say, if the lender requires repairs and the seller doesn't want to make them, the buyer can agree to make them to get the loan, or the seller can agree to pay more than the originally, that they have to get estimates, provide them to the borrower, and they can agree to make the repairs in order to keep the contract in place. So there is some language there about lender required repairs, how they're addressed. The seller may agree to pay them, the buyer may agree to pay them, and if neither agree to pay them, that the contract may terminate for failure of the repair contingency. Another thing to know is that VA has a requirement that if the property is on a well and public water has become available, that they may be required to hook into the public water supply, and that the seller has an obligation to pay for that up to whatever dollar figure the parties have agreed upon. And again, the same thing. The buyer can agree to pay the difference, seller can agree to pay the difference, and if neither agree to pay the difference, then the contract can terminate. The other thing to know about the government insured loans is what's called the amendatory clause. If your seller allows your buyer to get an FHA loan, one of the things that the seller agrees to in an FHA loan is if the property does not appraise, they will not force the buyer to buy the property. And that clause lives right up to the date of closing. If it's determined at the time of closing that it does not appraise, the buyer can say, I want out and I want my earnest money back, and they're entitled to it based on the amendatory clause in the FHA loan.
All right, we've got just a couple more questions. So if the seller gets an appraisal to set the listing price, does that appraisal last? That appraisal has absolutely nothing to do with a purchase and sale contract. That is just an informational appraisal for the seller, for the listing agent. That has no bearing on the contract. The lender is going to select the appraisal, and the lender is going to go by the appraisal, not that the seller provides, but that the lender's appraiser gets. Now, I will tell you, there are some companies out there that if you get a pre-listing appraisal and an actual purchase and sale appraisal comes in lower, they will help with an appraisal rebuttal, but it has no bearing on the contract. So there's not a question of it lasting or not lasting. Also, conventional appraisals do not stick or not attached to the property. Next question. After repairs are made, does an amendment have to be added to show that the repairs have been completed? If there are repairs addressed in an appraisal, the lender is going to send out the appraiser again. So it is the appraiser that is going to check on those repairs. And there is a fee incurred by the buyer for that reappraisal. Another question, what if you specified both in a contract? I don't know of any listing agents, and if you are a listing agent, you are not going to accept a contract that has both a conventional financing contingency and an FHA or VA financing contingency. So usually contractually, the buyer and the seller agree that the contingency is based on one specific family of loans, like Doug discussed at the beginning. If there has been one, I have never seen one in the over 25 years I have been working.
Yeah, agreed. I've not seen it either.
All right, Doug.
That bring us current on our questions?
I think so.
This is the part when I get to tell you, hang in there, because we're getting close towards break time. We'll take a 15-minute break midway through class. I think we'll get through about this section and then take our break. Understanding the loan process under TRID. What is TRID? Because of the importance of home buying to the American economy, and because of the government's desire to protect people, which is why we created the CFPB, the Consumer Financial Protection Bureau, the government has always had an interest in protecting buyers and protecting home ownership. The most recent regulation, which was back in 2015, was called TRID, which stands for TILA, T-I-L-A, that's the Truth in Lending Act, RESPA, which is the Real Estate Settlement Procedures Act. So this is the TILA RESPA integrated disclosure. So it's a disclosure process that's designed to meet Truth in Lending Act and Real Estate Settlement Procedures Act, which are two different government regulations that affect real estate closings. And one of the things that the TRID did is, before TRID, lenders used to give out a document called a good faith estimate. And the good faith estimate was the lender's estimate on what the cost to get the loan might look like. And the good faith estimate was not binding on the lender. And unfortunately, unscrupulous lenders would put whatever they wanted on the good faith estimate. And when the buyer's at closing with the moving truck in the parking lot, and the interest rate and closing costs were different, and the lender says, oh, I'm sorry, I couldn't get you that loan. I had to put you into a little bit different loan with different costs and rates. The buyer was kind of over a barrel. And what the CFPB, what the government said is, that's not fair. If lenders make a loan, they should have some liability for making sure those figures are accurate. Now that started in 2010. In 2010, we went from a 2-page HUD-1 settlement statement to a 3-page HUD-1 settlement statement. And the third page had all the information for the borrower about their loan. And it also had 3 sections of closing costs. those that cannot change at all, those that could only change by 10%. They had to be close but not accurate. And a third section is charges that are whatever they are. For example, your property taxes are whatever they are. The lender can't guarantee what your property taxes will be. So that was the first step at regulating lenders' uh, estimates to borrowers was in 2010. In 2015, they took it a step further and they did away with the good faith estimate. What the lenders provide the borrower now is called an LE, or a loan estimate. And they have to provide it a minimum number of days before closing. It has certain costs which the lender must guarantee, like in 2010, that these are accurate within an allowable tolerance, and so forth. The other thing that the lender said is borrowers should not be surprised at closing. They said, lenders, you should get a preliminary disclosure to your borrower 3 days in advance of closing, so they kind of have an idea what their loan will look like, and they're not just shocked sitting at the closing table. So we've got these, what we call TRID timelines, these deadlines the lender has to meet in order to get your borrower to the closing table. And the importance of that 3 days is, I mentioned my son who's closing tomorrow. He got a preliminary loan disclosure on Tuesday, and he said, I don't think this is right. I don't want to sign it. And I said, it's important that you sign it and acknowledge receipt. And here's why. The lender has to prove they gave you notice 3 days before closing. It doesn't mean it has to be accurate 100%, but if you don't acknowledge it, then we can't close on Friday because you have to acknowledge your preliminary disclosure 3 days before closing. So go ahead and acknowledge it, and whatever's wrong, we can still get fixed within the 3 days. So it's important that your borrowers understand that when they're signing some of these preliminary disclosures, they are preliminary. They will change, but there is an important element to the acknowledgement to keeping things on track from a timeline perspective. The other thing to know is the difference between the APR and the interest rate.
Doug, before you continue on, there is a question, and I've got a question too, actually. Is it 3 calendar days or 3 business days?
It is not calendar days but it's not business days. I think it works
Banking
similar.
days.
Yeah, well, it's the way I define it, any day the mail runs. So Saturdays count, Sundays and federal holidays do not.
Gotcha. And then my question is, because I know, so basically, as Doug said, there are certain lender fees that may not change. They must be guaranteed within that tolerance level, but there are other fees that change. And as you guys have experienced, sometimes closings get delayed and so forth and so on. So it's just those very specific fees that can't change, but that doesn't mean that these financial disclosures from the lender, that doesn't mean that that's exactly the money that the buyer is going to have to pay to buy the house. So Doug, my question to you as the attorney is, as an agent, or just having these discussions with our buyers, what should a buyer do? Like, should a buyer wire money to a closing attorney exactly for that amount? An overage, a shortage? How is it handled at the closing table from an attorney's perspective regarding what a buyer has been informed, what their cash to close, that's another term you guys will hear, is cash to close, what their cash to close will be based on these disclosures they are getting from a lender, and typically do they hear from an attorney how much money to wire, and just how is that addressed and actually handled in a practicality manner at the closing table?
My 2 thoughts in that regard. First are, the lender has a pretty good idea how much the buyer will need to bring to closing. When my son got his disclosure on Tuesday and I looked at it, it didn't have a lot of the things that I, as the closing attorney, add, like condo fees. It didn't show gift funds. It didn't show seller paid closing costs. It was largely an itemization of lender fees, escrows, mortgage insurance. So it was really more of a disclosure than an accurate closing disclosure. Now, that said, the loan officer said, I have worked through the numbers, and here's the number that you need to wire for closing. And I took his preliminary and I worked up the condo fees, the gift funds, the seller paid closing costs, and he was within $10 right on the money. So I think the answer to your question is, one, the loan officer will usually have a good idea how much the borrower needs to wire. The second thing is there is an interchange process where the lender, we're going to talk about this a little bit more, but there's a document called the CD, or closing disclosure, the buyer signs at closing, and the lender is responsible for it. But they send it to the attorney, who has to proofread it and go back to the lender and say, well, you need to add the home warranty, you need to add this, that, and the other thing, and so forth. So there's a process going back and forth. So I think the answer to the question, how much should the borrower wire? And I have two answers. One is the loan officer should have a pretty good estimate. I always recommend wiring something a little bit over that, maybe a few $100s. You'll get a check back at closing if you're over. The other thing is bring your checkbook to closing. If as long as you're close, if there's a small balance, you can settle it up at closing. So bring your checkbook. The other thing is the day before closing, in most cases, I mentioned that interchange process back and forth between the lender and the closing attorney. In most cases, the day before closing, the closing attorney can get you a preliminary closing statement with a pretty good eyeball figure on what the borrower's bottom line will be. So I'd start 3 days out with the lender's estimate, and the day before closing, get the closing attorney's estimate. And with any luck, they're going to be real similar figures. And then I always recommend wiring slightly over that, and also bringing your checkbook to closing in case there's anything that hasn't been accounted for, or any small amount that needs to be settled up on.
Thank you.
So we've spoken a little bit about these TRID timelines. Another thing that buyers see on their closing disclosure that's very confusing is the difference between the APR and the interest rate. The interest rate is what the lender charges to borrow the money. For example, you may borrow $200,000 at 3% for 30 years. And if you take a financial calculator and you put 200,000, 30%, 30 years, you know exactly what the principal and interest payment is. 3% is the interest rate. There will be a federal disclosure called an APR, which I tell people is not the rate on your note, and it's not supposed to be the rate on your note. What the APR does is it takes the cost of getting the loan, the cost of mortgage insurance, and it rolls these all together with your interest rate, solely for comparison purposes. I tell people it's like the gas mileage sticker in a car window. Everyone knows you don't get the mileage on the gas mileage sticker in a car window, but you know that every product has one. So you know, relatively speaking, that a hybrid will get better gas mileage than a Hummer. So the APR is strictly for comparison purposes. The government requires lenders to disclose the APR. And sometimes people ask me why. And the answer is they're trying to make it easier for consumers to compare loans between lenders when those loans have different costs and different interest rates. For example, one lender says, I can get you 3%. And another lender says, well, I can get you 2.875. And your borrower says, I'll take the 2.875. And we say, well, let's look a little deeper. To get the 2.875, he's going to charge you an extra $2,500 up front. And you say, okay, I get a lower rate, but I have to pay more to get it. What is the best deal in the long run if I take interest rate and closing costs together? And that's exactly what the APR is doing for you. It says if you take interest rate and closing costs together, here's the effective APR. So you can compare the two loans and see which has the lowest effective APR over the life of the loan. So the best deal may not be the one with the lowest interest rate when you take everything together. And that's the reason that an APR and interest rate are different. And that's the reason that the federal government requires lenders to disclose an APR. Now at closing, we're going to have a ledger that shows where all of the money comes from and where all of the money goes. And we kind of have in our minds a rough idea of what that looks like. If you're a buyer, well, how much do I need to bring to closing? Conceptually, well, you'd have to bring the sales price, plus your closing costs to get the loans, plus anything you owe the seller, your pro rata share of taxes, HOAs, things like that. And you say, okay, well, that's a lot of money. How am I going to pay for that? Well, you get certain credits. We'll subtract out of what you owe. What did you pay in earnest money? How much is your new loan amount? Were there any seller contributions towards your closing costs? Things like that. So that's what the ledger looks like. This is me getting my hands higher so you can see it. You have costs above the line, and then you have credits below the line. Your costs are sales price, closing costs to get the loan, any prepaids for taxes, condo fees, HOA fees, and the like. All those are your expenses. And then your credits are your loan amount, your interest rate, your seller contribution, things like that. And when we get to the net sheet, we'll see how those two play together. So we have lender closing costs. What's a prepaid? A prepaid is anything that the lender requires to be paid in advance. They might typically, they'll require homeowners insurance be paid up for 1 year at the time of closing. They'll also, another prepaid will be prorated interest. And you say, what's prorated interest? Well, lenders want loans to come due the first day of every month, regardless of what day we close. The other thing to know about interest is what we call paid in arrears. That means you get to borrow the money before you have to pay the interest on it. So if you closed today, the lender will tell you your first payment will be December 1st. And the December 1st payment is the interest that accrued on your loan in the month of November. You say, well, what about the interest that accrued on the loan pro rata from today through the end of October? And the lender says, we're going to collect that up front on the closing statement. We're going to collect the pro rata October interest on the closing statement. The November interest will accrue, and that's what your first payment December 1st covers. I have an expression that everything is easy once you know how. This seems kind of convoluted, but once you know how it works, it makes sense. The other thing that has to happen at closing is we've got to make sure taxes and insurance are paid. We want the seller to convey clear title, so we want them to pay current through the date of closing all the property taxes that are then due. We also want the buyer to pay at the time of closing or before to make sure the property is insured. Now, the way we handle the taxes depends on whether the tax bill has come out for the year or not. If we were closing in June, let's say July 1st, it makes the math easy. If we close July 1st and the tax bill is not yet out, what we'll do is say, buyer, you're going to pay the whole tax bill when it comes due later this year. And the buyer says, well, that's not very fair. I bought it July 1st. And we say, I understand. At closing, the seller will give you a credit for his half of this year's property taxes. And you say, okay, well, how are you going to figure out what the seller's half of the taxes are? And you say, well, we're going to use last year as an estimate. The taxes last year were $1,200 or roughly $100 a month. So on July 1st, the seller will give the buyer on the closing statement a $600 credit. So the buyer can then pay the taxes when they come due later the year, and each side will pay their fair share towards that year's taxes. We do the same thing with HOA or condo dues. our HOA has a $600 annual fee, and the sellers paid it for the current calendar year, and they close July 1st, and we tell buyer, you will reimburse the seller $300. That's your fair share of this year's HOAs. And that's how prorations work. The other thing to know about HOA fees is we want to make sure that the Condo Owners Association or HOA is paid current. That if there are initiation fees, transfer fees, letter fees, move-in fees, whatever fees there are, we need to get a letter from the HOA and make sure each side pays their fair share so that the buyer starts with a clean slate with the condo owner or HOA. In the GAR forms, the seller has to tell the buyer what some of these fees will be, and the seller guarantees that they tell them accurately. And if the seller doesn't accurately disclose, then the seller's liable for the difference. Discount points are, if you ask a lender, what's the interest rate? And he says, it's 3%. And you say, I'd like a lower interest rate. Can I get one? And the lender says, sure, I will charge you 1% of the loan amount, and you can get half a quarter or an eighth or whatever. I can get you a lower interest rate if you're willing to pay more to get a lower interest rate. And that's what the concept of discount points are all about. When we quote interest rates, lenders usually quote what we call a par rate. That's the rate with no cost. And the more you pay, the lower the rate you can get. Now,
excuse me, Doug.
Yes.
Can you please mute everyone again?
I'm so sorry. Sure.
Thank you.
The other interesting thing to know about discount points is that works both directions. You can say, I need help with my closing costs. What if I take a slightly higher interest rate? If you're willing to take a little more than whatever the par rate is, the lender will actually give you money. Instead of you paying discount points, they'll give you money. The only caveat to that is in most cases, the lenders have a minimum borrower contribution. You've got to put some percent into the deal. For my son buying the property that he's buying, he had to put 3.5% down. That was what his FHA loan required. So I can't cover that with gift funds. I can't cover that with seller contributions. They said, you, the buyer, must put this amount into the closing, period, end of story. But if you're above that minimum level and your borrower needs a little help, you can agree to accept a slightly higher interest rate. And in exchange, the lender will actually give you money towards their costs in exchange for, so there's a correlation between interest rate and discount points and closing costs. Dana, do we have any additional questions at the moment?
No, none that I see. You've answered everything.
Which is fantastic. And I think it's a great time for a break. I'm not sure what time you have on your watch. Dana, I'll let you be the official timekeeper, but we'll take a 15-minute break and then we will resume with the exciting conclusion to show me the money and get me to closing.
That sounds great. I've got, I'm going to take back the host, and I have got, awesome. I have, and Doug, if you will stop your share, that would be awesome.
Stop and share.
That's okay. Terrific. All right, everybody, let's take a 15-minute break. It's just about 11:45. So everybody go take a break, come back at 12 noon. And when you get back, please again, type in your name, email address, real estate license number, and we will stay tuned for the exciting conclusion when Doug gets back after the break. So everybody come back at 12
Thank you, Dana.
noon.
I'll see you at noon.
All right. We are going to get started back. Like any continuing education class, There is a course evaluation, and the way we do the course evaluation through the Georgia Real Estate Academy is I am getting ready to launch a poll. So on your screen, we're getting lots of thank you, Dougs. On your screen, you are going to see, I'm going to launch it right now. You are going to see a pop-up that says CE course evaluation. It is anonymous. Please go through. There are five questions. You will see a submit button at the bottom of the poll. Once you have scrolled through and answered all 5 questions, that submit button will turn blue and you hit submit and your answers will be submitted. Since I have already launched it, I cannot relaunch it or I lose all the answers for the people who are answering. So just do the best you can. If you have technical difficulties with it, at the very top, you'll see a little minus sign or an X sign. You may simply minimize the poll or get rid of it. But we appreciate your answering the poll questions. I will leave it up through the end of class. And I believe, yes, after you answer all 5, you hit submit and it will submit. All right. I believe that is it. I don't see any more questions. I'm going to mute everybody again. And then Doug, I am going to, let me find where you went. I'm going to hand the host back to you. Here we go. All right. You got it, Doug. You're muted.
Thank you. I am going to start by sharing my screen and going back to where we were. Give me just a second. Well, bear with me again. Appreciate your patience. Bear with me one more moment here. There are too many windows open. It's hard to see everything all at once. That's better.
All right.
All
right, Doug, we are back to seeing your screen.
Wonderful. I'm going to work through just a quick example. Where we left off, we had talked about the government, the TRID, the APR, so on and so forth. That was where we had left off. And we're going to start with the basic math, calculating cash to close, and so forth. And the way I want to do that is with a little example that I was pulling up in Word. Bear with me just one second. Let me see if this will work with the shared screen. Do you see a Word document with some digits on it? Dana, do you see a Word document with some numbers on it? I want to make
Yes,
sure
Doug, we see a document that says sale price 212.5, loan amount 208,650.
This was an example I was going to use. I'd mentioned that I've been working with my son. He's buying a condo for 212,500. He's getting a loan for 208,650. And I talked about this idea of putting a little line and then figuring out what's above the line and what's below the line. So for my son as the buyer, what's my expectation on what he might have to pay? Well, he's going to have to pay the loan amount. He's going to have to pay his closing costs, and I'm just using wild guess numbers. Let's say his closing expenses are $5,000. He's going to reimburse the seller for his pro rata share of this month's HOA, which we'll call that $300. He's also going to reimburse the seller because the seller will pay all of the taxes current. That's the HOA proration. And the reason for that is the HOA is about $450 a month, and we'll be about a third of the way through the month. So he'll have about, that's how I'm ballparking, 300 for the HOA prorations. And let's say his property taxes are about $2,800 a year. So he owes roughly October, November, December. And the whole idea is I want you to not have to do it with a calculator, but be able to eyeball it. If you know what the numbers are, you'll know how to break in and compute them in more detail. So 2,800 and roughly 1/3 of that, call it maybe $600, $650 in prorated taxes that he'll owe. He'll also owe his prepaids. His prepaids include $550 for insurance, and his condo fees. He'll owe an initiation fee, which is about $850 for initiation, and he'll owe the November dues, which are about $450. So that's kind of a ballpark of the expenses he'll have. And I'm going to just manually sum total this. That's 217, 218, 219. Yeah, I could probably get a calculator and do it a little better. So ballpark, his expenses above the line are about 220,000. Bear with me. 220,300. Okay, that's great. He doesn't have 220,300. How's he going to pay for that? Well, below the line, his credits are, well, he's paid 1,500 in his earnest money. That'll go towards the costs. He's getting a new loan amount of 208,650. He's getting 4,000 in seller paid closing costs. Dear old dad is giving him 5,000 in gift funds. So what are his total credits? It works out to be, let's see, that's 9, 10, 218. So for round numbers, 219,650 in credits. And now, I feel like a magician who hasn't practiced his trick because my numbers I'm coming up with aren't working exactly. He needs to bring 3.5% and 3.5%. That's the 3.5% figure that he needs to bring. That's his minimum down payment. His minimum contribution is 3.5% of the sales price. All right, bear with me one second. I'm going to stop the share and just pull up his actual, just see where I'm off on my numbers, just so I'll have something that's a little more accurate for you to look at. But I wanted you to visually to see how to rough out these numbers.
Doug, in the chat, we've got a comment, 3.5% down payment for the FHA loan, you mean?
That's right. For his, he's getting an FHA loan, and so they require him to put 3.5% of his own money into the deal.
While Doug's doing his calculations, I will remind you guys as agents, it's very important to have a good working relationship with your lender and your closing attorney. Because sometimes these numbers, there might be issues we're not aware of or certain fees. So you definitely want to make sure that your buyer, you want to stay in communication with your lender, but you don't want to take the place of your buyer communicating with the lender. Because a lot of the times the lender can explain stuff to the buyer based on different underwriting criteria or buy down points or things like that.
All right, I'm going to start to share my screen now that I've got a little better figures that we can work with. I had underestimated his amount for closing costs and lender fees. That was where I was off, but my ballpark and where I get each of these figures, of course, sales price we knew from the contract, closing costs and lender fees were from the lender's estimates. HOAs, we had an idea how much the HOA was and the taxes, so we knew how to just rough out the proration. We knew about how much his insurance was and condo fees. So the total, this is above the line. These are his estimated expenses, and his credits included his earnest money, his loan, his seller paid closing costs and gift funds, which came to this amount, meaning the amount he needs to bring to closing was about 50-50, a little over 5,000. And you say, well, he's got to put 74,3750 in. Well, how's he getting to that? And the answer is, well, he's already on top of the 5,000. He's already paid 1,500 in earnest money. He's paid his insurance, And there were other expenses that don't total into this because he paid them in advance. For example, the closing costs don't include the appraisal because he paid for the appraisal up front. So when we get to, this is an estimate of his bottom line for closing. And you say, well, okay, but how did he get to, boy, I can't type. Here we go. I'll just go with that. How did we get to 7,400 if he's only got 50/50 in it? Well, he's already paid 530 for the appraisal and credit report. He's paid his 1,500 in earnest money. And there was one other expense that I'm leaving out here, but when we added it all up and say, well, he's only bringing 5,000 to closing, but I can show that he actually does have, it worked out to be right at the 7,400 here in his contribution. That doesn't mean he had to bring 7,400 to closing. We just had to show he put 7,400 for the items that he's prepaid, you know, what he brings to closing, his earnest money, and the items that he had already paid for in order to get the loan. Does that make sense? This concept of working, what are your expenses above the line? What are your expenses below the, or your credits below the line? And that's how you rough out a buyer's bottom line on how much money they need to bring to closing.
Doug, I have a question. What is the PITI? If you could go through that just a little bit.
I can. I will. Let's see if I've still got his closing disclosure up.
And I don't know if that means conceptually or actually.
Well, I want to get some semi-accurate figures. To compute PITI, we're going to start with principal and interest, which I'm just going to ballpark at 850. That's principal and interest. Where did I get that? I got that from the lender figures, and that was based on the loan amount at, I think he's getting actually 2.5% interest. So we've got principal and interest for the payment. Now we've got to rough out his taxes, and, or excuse me, his insurance. It's a little bit less than 600 a year. 600 a year is $50 a month. Let's just ballpark it at 50 a month for insurance. His taxes, I think I'd mentioned, were about 3,000 a year, and 3,000 divided by 12, about 250. And that's for taxes. And lastly, his mortgage insurance is about 150 a month, which means his total payment, 850 plus 150, is about $1,300 a month. So that was roughing out his monthly payment. And this is a little condo in Buckhead, 2-bedroom, 1.5 bath. He had been renting a 1-bedroom, 1-bath apartment, and guess what he was paying? $1,300 a month. So he's an example of someone who was able to buy for, it's actually a little more because he's still got an extra $450 a month in his condo dues. So he's got, instead of a 1-bedroom, 1-bath for $1,300, now it's $1,750 including condo dues a month. But now he's got a 2-bedroom instead of a 1-bedroom, so he can have somebody else share the expenses with him. So that's how I kind of roughed out what his payment would be. So let's do the same thing for the seller side. Let's rough out our seller's number. What's above the line for the seller? Well, the seller's going to get the sales price. He's going to get the buyer's reimbursement for their prorated portion of taxes, 300 and 650. I'll just copy those figures. These were expenses to the buyer, but they're credits to the seller. The seller gets the sales price. The buyer reimburses his pro rata share of HOAs and taxes. Which puts the seller getting roughly 213, 450, if I've got my math right. That would be the gross amount due to the seller. But I've got to back out some expenses. What does the seller owe on his mortgage? I'm going to say it's $150,000. He owes some sales commissions. His sales commissions are 6% of the sales price. That's $12,750. He is also going to be less $4,000 in seller paid closing costs. So what's coming off of what's due to him is 150, 12,750, and 4,000, 166,750. And those are his expenses, which means his seller net is about 213,450 minus 166,750. Or his bottom line seller net is about 46,700. Does that make sense? Do you see what the numbers are, where they came from, and what they represent? And you see which figures go to the advantage of the seller and which figures come off of the seller's figures. In other words, what gets added to the seller and what gets taken away from the seller. The last thing I wanted to touch on was calculating taxes. You should have an idea. It's fairly easy for any county to just Google the county tax commissioner, and I believe you probably got access it through MLS and others to have the amounts for taxes. The key thing to know in computing your seller net and buyer's net or cash to close is whether the taxes have been paid for the current year or if they're due. If the taxes are not out for the year, what happens is that your seller pays to the buyer the prorated taxes, and that the buyer will then pay the whole bill later in the year. So if the taxes aren't out, the seller gives the buyer his prorated share. If the taxes are out, then the seller pays the whole year, but the buyer reimburses the seller for the buyer's pro rata share. And do you see how that works? Well, I used an example earlier where the tax bill was $1,200 and we closed on July 1st. And since the bill wasn't out, the seller gave $600 to the buyer in prorated taxes. Let's assume that the bill was out. Then we would have the seller pay the $1,200 and the buyer would reimburse 600 to the seller for his pro rata share. Does that make, I hope that makes sense.
So we've got a couple of questions. And when Doug says the taxes are out, what he means is the tax bill, the bill for the taxes. Once the county in which a property is located issues the tax bill, which for a lot of our metro counties, it's October, for some it's September. Then that entire amount owed to the county becomes the responsibility of the person that was on title as of the time that tax bill was issued, which is going to be the seller. So that's why the closing attorney has to collect the entire full year's tax bill at closing. Now, I'll let Doug answer the question about, well, what if Doug, I've got a mortgage and you know, I've already paid that. I've been escrowing that all year. My mortgage company pays that. Why are you collecting the entire tax year, the entire tax bill at closing when I've already paid it? My concern, a lot of sellers' concerns once the tax bills are out, is that they are double paying.
Sure, there's two things to consider. Escrow is your money that a lender holds to pay your taxes. As the closing attorney, if the county shows the tax bill is due, we must collect for it and pay it. Now, what will happen is when your lender gets the payoff, they will refund your escrow payment back to you. The other thing that sellers get frustrated with me this year is my lender says they've paid it. And I say, it doesn't matter. The county says they're not paid. When the lender says they've paid it, a lot of times what they do is they give the money to a third-party tax service, and the tax service makes the payments to the taxes on behalf of the lender. And that's a cumbersome process that takes time. If the bill is unpaid, we must collect for it at closing. And what will happen is the borrower will get those taxes refunded by the lender or the tax service company.
And just let me see if there was another question. Do you do an agreement to recompute after the bill comes out if it's drastically different between the buyer and the seller? That's already in the contract. When a buyer and a seller sign the GAR and the RE Forms purchase and sale agreement, it already says that they agree between themselves to work out any differences in the prorations. And I believe, Doug, you might have a document at closing that gets signed to that effect as well.
That's
correct.
True? There are two answers to that question. One is it's addressed in the contract that says if any item is prorated based on an estimate, the buyer and seller agree to reprorate when the actual bill comes out. So in other words, if I prorated July 1st and I said the bill is $1,200 last year, so it's $600 on July 1st. And then when the bill comes out later in the year, it's actually $2,400. And we say, gosh, instead of $600, it should have been $1,200. One party owes the other party the additional $600. They agree to reprorate when the actual bills come out. A quick word about seller's mortgage payoffs. What I want you to
I'm sorry, Doug, I'm going to interrupt you one more time.
Sure.
Also, just for you guys that have access to the GAR, Georgia Association of Realtors contract forms, there are two forms that they have to help you out with these calculations so you don't have to remember everything. And one is the F837 estimate of net to seller, and the other one is the GAR F840 estimate of cash to close for buyer. So just wanted to let you guys know there are those worksheets to work through. And Doug, there was one more question I skipped about where are the closing attorney's fees?
They were included in that figure on closing costs, the lender and closing costs. So they were included in that figure. The 837 and the 840 do similar to what I was doing on just a plain white scratch sheet of paper. And that's helped itemize what are the charges or expenses and what are the credits. So it works you through computing the credits and the debits. It's helpful to use those forms because you're not working from a blank sheet of paper like I was, but it prompts you to enter things like HOAs and commissions and sales price and loan amount and seller paid closing costs. So it will help walk you through computing those numbers. What I wanted you to know about payoffs is, you remember how I said that a mortgage is paid in arrears, meaning when you make your December 1st payment, that was the interest for November. And a loan accumulates interest every single day until it's paid off. So in the example I gave, if the seller looks at his mortgage statement on October 1st, that was the payoff on the loan balance on October 1st. It's accruing interest every single day after that. And we need a payoff, not good through tomorrow, October 9th, the date of closing. We need at least a business day or two beyond that, because we have to allow time to either overnight a check or wire the funds. So by nature, the closing attorney has to build in a few extra days of interest. Now, your seller will get that back when the lender receives the payoff. Attorneys make sure the payoff is what we call padded. It's a little over what it needs to be. But that's why when your seller looks at his mortgage statement and he looks at the payoff and he says, well, this is more. The two reasons are it's accruing interest every day after the date of that statement. The other reason is sometimes lenders have payoff fees. They're going to charge to record a release. They're going to charge for recouping the closing cost on a home equity line of credit if it's paid off in a certain amount of time. So there can be some other expenses that go into the seller's payoff. So I want you to understand that's how the balance due on a payoff is not the same as what your seller sees on their mortgage statement. Now I want you to understand how interest being paid in arrears means that it's accruing interest every single day from the last payment. And we walked through computing a seller net sheet. The attorney's role, what does the attorney do to do the closing? Couple of things I want you to know about this. First, in Georgia, the closing attorney represents the lender in making the transaction, making the loan. Not the buyer, not the seller, not the agents. The attorney's client is the lender. If there is no lender, the GAR contract says the closing attorney represents the buyer, but there's actually some question about that. Remember, the closing attorney is not a party to the contract. And attorneys say other people don't get to decide who our client is. The attorney decides who their client is. So in a cash transaction, it's important to ask the attorney, do you represent the buyer or seller? My position is I represent whichever party brought the closing to me. Usually I'm doing the closing because I know the agent for the buyer or the seller, and they selected my firm. So if the seller picked me, I'd say I represent the seller. And if the buyer picked me, I'd say I represent the buyer. Now, the flip side of that coin is when you think of representation, you think of courthouse and you think of two parties with their own lawyers. In a cash transaction, I use standard forms and standard documents. And I really don't do anything different to do a closing where I represent a buyer than if I were representing the seller. I use the same forms. I do the same math on the closing statement. So it isn't fundamentally different as to who you represent. The other thing that the attorney is responsible for is recording deeds at the courthouse. After closing, we take deeds and we send them to the courthouse along with all of the money the courthouse wants to record the deeds. That money is three figures. One is the recording cost, and that's $25 per document. For a warranty deed, there's transfer tax. That's $1 per thousand based on the sales price. And for a loan, there's mortgage tax called intangible tax, and that's $3 per thousand of sales price. So let me use a simple example. Let's say it was a $200,000 sale and a $100,000 loan. After closing, I'm going to send a warranty deed and a security deed, which secures the lender's interest in the property. The warranty deed needs a $200 check for the transfer tax. The security deed needs a $300 check. That's $3 per thousand based on 100,000 of loan amount. And each deed needs $25 for the recording fees. The other thing the seller does is handle all the money. They serve as having a trust account. They take all the money in according to the settlement statement, and then they pay it right back out the way that it's shown on the closing statement. So I get the earnest money, I get the loan amount, I get the buyer's money for closing, and that's all the funds for closing. And then I turn around and give everyone a check. I pay off the seller's loan, I give the seller his proceeds, I give the agents their commissions, I cut checks for the title insurance company and for the clerk of court to record the deeds, mortgage tax, intangible tax, and recording fees. And hopefully there's one check left over for me because I get a little money out of the transaction as well. The attorney's role in a cash transaction I had touched on earlier. The attorney serves two fundamental purposes. One is to serve as an escrow agent, someone that handles all of the money on behalf of both parties. The other role the attorney serves is facilitating the transaction, preparing documents, getting them executed, sending deeds to the courthouse to be recorded, and handling the title insurance. And the attorney's roles for that in a cash transaction really are the same whether they're representing the buyer or the seller. People ask me a lot of times, how fast can you close a transaction? What's the time frame for closing? And I said, well, it's like, asking how big is a cake? Well, I don't know, there's a lot of cakes. They can be all kinds of sizes. How quickly can I do a closing? Well, it depends. I have to run a title exam. I have to get payoffs for anything like loans that are on title. I have to prepare documents. The lender needs time, if it's a loan, to process the loan. So there are a lot of factors that go into determining how long will it take to get to the closing table. Typically, the pacing item is how long does the lender need to process the loan? That's usually the most pressing. We can usually get title in a few days. We can usually get payoffs in a few days. So the best answer to when you're determining what should be your closing date would be to consult with your lender and ask them, how long do you need to process this loan? What should we estimate for the closing date? The TRID issues, I touched on that earlier, the fact that the lender
Doug, before you continue on, or my part of this, we've got a few questions.
Sure.
One is, how long does it take for the attorney to draw up the paperwork when the mortgage is clear to close? The next one is, what are the differences between a warranty deed and a quit claim deed? And it's quit, Q-U-I-T, not quick, Q-U-I-C-K, quit claim deed. And the third is, would you recommend the party not represented by an attorney at closing get their own lawyer as well? If so or not, what would be the advantage or disadvantage?
Great, three great questions. I'm going to start with the one in the middle about the types of deeds and say, put that one in the holding pen because we'll cover the types of deeds a little later in the slides. The first one, remember I mentioned that when the attorney draws up loan documents, there's some back and forth exchange between the lender and the closing attorney. The attorney gets the condo or HOA letter. The attorney gets the taxes, things like that. So usually by the time the lender is ready, the closing attorney is also ready because we've been working back and forth together. The other thing is a lot of what the attorney does is fairly automated. When I get my lender's documents and I've already built my closing statement, it doesn't take long for the attorney to generate their side of the documents. So how long does it take for the attorney? Usually when the lender is ready, the attorney will also be ready. And I'm sorry, the second question, that was the first question. The second was about deeds, which I said we'd come back to. And,
Okay.
and I'm sorry, what was the third question?
Uh, the third, and then there's another question about what an acronym
Oh, I'm sorry. The
stands
third
for
one was
again.
about whether or not the parties need an
Sure.
attorney. I get that question occasionally, and I tell them, as an attorney, if someone asks, do I need an attorney? The worst thing I can do is say, no, you probably don't need an attorney. Because if something goes wrong and they say, I wish I was represented. So from a liability perspective, I always tell people, if you think you need an attorney, get an attorney. But I would also say it isn't customary. In most cases, what the closing attorney is doing is very standard and formulaic. The agent is assisting their party with making sure the terms in the sales contract are accurately represented on the closing statement. And most of the steps, because they are fairly straightforward, don't require each party to have their own attorney. If for some reason there's been some disagreement or, there are situations where a party might say, I want my own attorney. I've had friends who've said, will you go to closing with me? Will you be my attorney at closing? And I'm not the closing attorney. And I say, I can, but remember, I can't do much. The lender won't change any of their loan documents. Their loan documents are standard forms and they won't change it. I'll look over your closing statement and your contract and make sure they match, although the closing attorney should be doing the same thing. So if I go to closing with you, there really isn't that much I can do for you. So that was the answer to, I would say it isn't customary for every party, in Georgia anyway, for every party to get an attorney, just the one closing attorney to handle things.
And I will add on that, when you guys read in the contract, a way to explain this or for you to understand it or to explain it to your parties is when there is a loan involved, as Doug mentioned, the closing attorney represents the lender. And the closing attorney gets, as Doug mentioned, the package from the lender. Well, what's the package? It's nothing more than a set of instructions to Doug or the closing attorney how to prepare the paperwork. Well, when there's not a lender involved, there is no set of instructions to a closing attorney how to prepare the paperwork. Now, I am simplifying this to the most simple level. Of course, closing attorneys know how to prepare paperwork and so forth and so on. But with respect to the not having a package, the contract, and this is just a provision, I will say, in the GAR purchase and sale agreement. This verbiage that without a loan, without a mortgage lender, the closing attorney represents the buyer. That is only verbiage in the GAR contract. In the RE forms contract, it just says you fill in the blank, buyer or seller have the right to select a closing attorney. All that means is the closing attorney is directed to prepare the paperwork with respect to the buyer's position in the contract. Now, that contract is pretty even-handed where it's not going to be anything unfair against the seller. The closing attorney prepares the deeds and so forth and so on based on the contract instructions themselves. But there is no attorney that I am aware of that will represent a party's interest should there be a dispute for free. So make sure your buyers understand if they are paying cash and the GAR contract says that the closing attorney represents the buyer, that by no means means that they have legal representation should a dispute arise between the buyer and the seller. That just is information regarding the preparation of documents for closing. So just wanted to kind of reframe that just a little bit because nothing's an issue until it's an issue. And when there's a dispute, the buyer is going to sit at the closing table and say, well, he's my attorney. And that's not the case. I don't think he's paid a retainer fee or engaged the closing attorney as personal legal representation in a dispute. So just wanted to kind of clear that up just a skosh. The other thing is defining trade again. A lot more questions, Doug. Does the seller pay for the closing attorney? Is there an average cost for a closing attorney? Can that be the same day on mortgage approval and closing on the same day? In a cash transaction, is it still better to have a closing attorney to make sure title, lien, etc.? Yes, you have to, in Georgia, you have to close with an attorney. So those are some more points to cover, Doug. And depending on how much more of your presentation, we've got 15 more minutes. And then did your son buy owner's title policy on the condo?
He knows his dad well enough that I wouldn't let him close without getting owner's title. The answer is that how much does a closing attorney cost? They're all within the same range. Most closing attorneys pretty much know what each other charges. So there are some that are more expensive and there are some that are less expensive, but they don't differ that much. The contract typically stipulates it's a matter of contract as to who gets to select the closing attorney. It's also in the contract as to who pays what expenses. The GAR contract, and I believe in the RE forms, the buyer is typically responsible for most all of the closing fees. The seller is responsible for items necessary to clear title, like payoffs and taxes and things like that, and any other expenses that they've agreed the seller will pay. For example, a home warranty. The seller is responsible for commissions. The seller is responsible for any seller-paid closing costs. But for a variety of reasons, it's always best, and it's under Georgia law, a deed is the practice of law. So they require closings to be done by attorneys in Georgia. Just briefly, when an attorney goes to do a closing, their job is to make sure that the buyer gets good title, that the seller conveys good title to the buyer. And the way we do that is by running a title search to determine, is the seller the rightful owner of the property? And is there anything affecting the title that we need to address? So for example, in my son's case, we ran title and determined the person on the contract as the seller is the owner of the property. We have the deed where he purchased it. We determined that he had one loan against the property and no other liens or items. We determined that some of the taxes were paid and some were not. So we will collect from the seller what's necessary to pay all the taxes current, and the buyer will reimburse the seller the buyer's pro rata share. So at closing, we will clear up anything on title. The other things to know about the various types of sellers, if it is an estate, meaning someone has died, our title work needs to find the proper probate paperwork. When someone dies, someone needs to be appointed what's called the personal representative. And that can be the executor if they had a will. The same role is called an administrator if they didn't have a will. But we need a personal representative for the deceased, and those probate paperwork needs to give them the authority to handle the sale of the property on behalf of the deceased, and that would be typical. If it's a corporation who's a seller or an LLC, we need to make sure we have the proper corporate officers to sign and that they have the authority on behalf of the corporation to sign for the sign on behalf of the company. My law firm is Shafritz and Dean LLC, and I'm one of the managing partners and owners. If Shafritz and Dean owns property and we go to sell it, I would show the closing attorney, here's my corporate paperwork. It says that I am an LLC member, and it says that I have the power to sign on behalf of the LLC. REO sellers, that means real estate owned by banks, and it's a similar situation. We need to make sure the person signing on behalf of the bank is the authorized corporate officer to do that. With investors, either they're individuals or they're entities, and we do the same thing. Are they the rightful owner of the property if they're a seller? And if they're an entity, do they have the authority to sell the property? A short sale means that the lender with a loan against the property is willing to accept less than they are owed in order to allow a sale to happen. And that typically means the buyer is what we call underwater, meaning the property is no longer worth what the outstanding loan amount is. The special issue with that is the lender has to approve the short sale. They have to fully understand the transaction, and all the parties have to comply with the terms of the short sale. Title issues. One thing that I joke about, I mentioned earlier, my brother's an anesthesiologist, and the reason my job is better than his is it's easier for me to fix mistakes. When doctors make mistakes, it's hard to fix that. If I make a mistake, no mistake I make can't be fixed with some amount of money or the proper document. So when we do a title and there's an issue, we can usually fix it by either determining who needs to be paid what amount of money or determining who needs to sign what document. For example, we had a deed recently. It was supposed to have been executed by the husband and wife. Only one of them executed, and they put an X for the other's signature. And sometimes a person will make a mark as an X for a signature. It turns out they hadn't done that. And to clear title, we had to go back to that person and get them to sign a new deed to have all of the interest addressed. For title insurance, what title insurance does is it guarantees the policyholder that they have the interest in the property that they bargained for. If you're a lender, the interest you bargained for is to have a first mortgage against the property. If you're a buyer, the interest that you bargained for is good, clear, fee simple title. So title insurance guarantees a lender, yes, you have a first mortgage against the property, and it guarantees the buyer, yes, you have good fee simple title, subject only to things that were there that we couldn't change. When my son buys this condo tomorrow, he will still have to pay condo fees. It's a condo, that's recorded, and I can't change that. He will also won't cover things you do to the property. His title insurance won't protect him against paying his own loan. He agreed to put a loan against the property. So title insurance doesn't protect things that are there that we can't change and things that you do to the property. And the issuing of title insurance is based on doing a title exam, determining what needs done to clear title, and doing those things at closing. The contracts call for marketable title. Marketable title just means it's title that a title insurance company licensed in Georgia will insure at regular rates and with no special exceptions, with only the standard exceptions. And that's how title is defined. The issues we run into with HOAs is there are two issues. One is HOAs require payment of money. They require dues and fees to be paid. So before closing, we get a letter from the HOA or the Condo Owners Association, and it tells me, is the owner of the property current on all the money they owe their association? If not, we collect for it at closing and bring it current. The other thing we do is we determine what needs to be collected at closing. And I touched on those earlier. Transfer fees, initiation fees, move-in fees, move-out fees, capital contribution fees. So what the goal here is to make sure that the buyer gets a clean slate with the association. They start fresh and all dues are paid current through closing, and now they have the responsibility to pay those dues. If a seller hasn't paid an HOA, we can usually fix it by paying it current at closing. The other thing we have to look for are violations. Um, we had a situation where a buyer bought the property, and after property, they got a bill from the HOA that wasn't on the HOA letter, and they said the seller had a violation because they cut down trees and the stumps needed ground up, and the seller hadn't ground up the stumps. So they told the buyer, "You're going to have to grind up all these stumps." So it was an HOA violation. It wasn't a dollar figure. The HOA was paid current, but there was an HOA violation that the buyer had to correct. When we talk about deeds, what a deed is a deed that has two parties, a grantor and a grantee, and it conveys an interest in property. A general warranty deed is where an owner of the property says, "I am the grantor, you, the buyer, are the grantee, and I am giving you my title to the property." The word warranty is the important part of it. In a warranty deed, the grantor tells the grantee, "I am the rightful owner of this property, and I am guaranteeing to you that I do have good title to the property. And if you later find out I didn't have good title, come back to me. I have to fix it for you. I have given you a warranty of title or guaranteed good title to you." Now that sounds great, but as a practical matter, if you buy a property and you have a title problem, do you want to go find the person that used to live there and try to sue them in court to fix the title? There is legal significance to warranty of title, but the best protection for title is to have a title insurance policy from a Fortune 500 company. If you, the buyer, find out you don't have good title, rather than trying to find the seller and sue them under the warrant of title, is go to the title insurance company and say, "Fix this for me, please. That's why I have title insurance." But the legal significance of a warranty deed is the grantor warrants good title to the grantee. A limited special warranty deed is where the person says, "I warrant title to you, but only those that can legitimately claim by and through me. I'm not warranting title against people that really don't have any legal claim to the title. I'm warranting that I have good title by those that legitimately, in other words, I haven't already sold it to somebody else." So they put certain limitations on the deed. As a practical matter, from title insurance, it doesn't matter if it's a limited or a general warranty deed. The GAR forms call for a limited warranty deed, and that's fine. In a special warranty deed, the grantor is telling the grantee, it's used most often in after a bank has foreclosed, and they're saying, "I got title through foreclosure, and I really don't know about the back history of the property, but I am warranting what I have to you, but I'm not warranting it against everybody." A quitclaim deed gives no warrant of title. In a quitclaim deed, the grantor tells the grantee, "Whatever interest I have in this property, if I have any at all, and I'm not saying that I do, but whatever I have, if I have any, I give to you." And you say, "Well, that sounds pretty weak. Why would you ever want a quitclaim deed?" We use them a lot of times when ownership of property is murky. There's been some question in a probate situation, and we know that the rightful owner is one of the three heirs, but there's some question about who is the rightful owner. But we know it's one of the three. Well, none of the three want to warrant it because they can't guarantee they have good title. But if all three will quitclaim their interest, we know we have all the interest, and we know that the buyer got good title. So even though a quitclaim deed, it just means whatever I have, I give to you, and it sounds weak, there are legitimate reasons that we use a quitclaim deed. Another place where I use quit claim deeds is I have a seller with property, and then the buyer gets a survey. And the seller says, I will only warrant title to you the same way it was warranted to me with the old legal description. I will also give you a quitclaim deed where I quitclaim the property in the survey, but I'm not going to guarantee the legal description in the survey because that's not the way it was guaranteed to me. So when someone gets a new survey, the seller warrants it to the buyer the same way it was warranted to them, and then they quitclaim to the buyer the same way it appears on the survey. The other type of deed is a security deed, and in a security deed, the grantor is the borrower, and he grants a security interest in the property to the lender, the grantee. And what he says is, if I fail to meet the terms in the note, you have the right to retake the property. And that's what foreclosure is. In Georgia, the borrower gives the lender the power to sell the property. If I don't repay the note according to its terms, just tell me that I'm in default and give me a chance to fix it. If I don't fix it, you may advertise it for sale, go to the courthouse steps and do a little auction. And that's not unique to any lender or any law firm. It's how we do foreclosure in Georgia. And that's what the security deed says. The security deed says that I give you a security interest in the property, and if I don't repay it according to its terms, you may use Georgia's non-judicial foreclosure process to sell the property at auction on the courthouse steps. What happens at closing? What documents do we sign?
Doug, I'm going to interrupt you just for 1 second before we move on. It is 1 o'clock, and just a couple of quick questions about title. Owner's title policy still being separately offered by a title insurance company. And I guess along with that, if a buyer does not get owner's title policy at closing, can they get it? What time frame after closing can they still get it? That's one question. Is one title company a better company to have a policy from than another? And let's see, there was another question. Shoot. Can a buyer choose the title company?
Okay, 3 questions, quick answers. Is one title insurance company better than another? My answer is, as long as they are licensed to do business in Georgia, they are an acceptable title insurance company according to the GAR or the RE forms contracts. So that's the minimum Mendoza line. Beyond that, I don't have a strong preference one over another. You can do a little due diligence and make sure you're working with a strong, financially solvent insurance company, which is always a good idea with any type of insurance. Typically, nothing in the contract gives the buyer the right to pick the title insurance company. The closing attorney is an agent for one or more title insurance companies, and they will pick a title insurance company that they are an agent for. So nothing in the contract gives the buyer the right to say, I want XYZ title insurance company. The other question is, if they don't buy owner's title at closing, can they buy it later? I encourage people to buy it at closing for 2 reasons. It is cheaper then than it will ever be in the future. There is a discount called simultaneous issue that when you issue a lender's and an owner's policy at the same time, there's a discounted rate for the 2 policies. And if you don't buy them at the same time, you don't get the simultaneous issue rate. The other thing is the attorney had to do all the work on title to issue a lender's policy. So there's no additional work to issue an owner's policy. If you wait, the closing attorney has to update title. There are additional fees to do that. So I always encourage people to get it at closing. If they don't, most attorneys for up to 30 days after closing can still issue the owner's policy for the same rate, give the simultaneous. After 30 days, it's not usually possible. And I apologize that we're running a few minutes behind. I'll tell you, I've had a good time being your instructor today. We have only 2 slides to go, and they're fairly straightforward. The document signed at closing, seller signs a warranty deed to transfer title to the buyer. The buyer signs a security deed, giving the lender a security interest in the property. The buyer signs a promissory note. That's the legal agreement between the buyer and the lender for the terms of the buyer's loan. We have various affidavits signed at closing. Affidavits are where people say that certain things are true. The seller signs an affidavit that there are no other loans or liens against the property that are not on title, that nobody else has a right to the property, that they haven't had anybody work on the property and not paid them, so they're going to file materialman's liens, things like that. So affidavits collect basic information that the attorney wants to know is true as part of doing the closing. Same thing with the various acknowledgments and disclosures. I want to make sure that the parties acknowledge that they went over the closing statement, that it's true and accurate, that type of thing. The lender documents include the ones remaining here. A loan application is everything the lender collected about the buyer to process their loan. And I want the buyer to sign the loan application and say, yes, everything I told you to get the loan was true then and it's still true today. The lenders get some IRS forms. A W-9 just lets the lender certify they have the buyer's social security number correctly. And that's so the lender can report the interest the buyer pays to the IRS for tax purposes. They also get some forms called 4506 and 8821s. Those just allow the lender to get a copy of the borrower's tax return to verify financial information that the buyer gave to the lender. The other key one is a first payment letter. This tells the buyer, this is your total payment. This is the breakdown for your total payment. This is when your first payment is due, and this is where to send your first payment. So right there at closing in the loan documents, the buyer has everything they need to begin making their first payment when it's due. The last thing that I wanted to touch on was reading the closing disclosure. The closing disclosure just tells the parties everything they want to know about the loan. For a buyer's closing disclosure, page 1 has the basic loan information, loan amount, interest rate, principal and interest, payment breakdown. Page 2 is a detailed breakdown of closing charges. Page 3 is a summary of the transaction. It does what I described in the Word document earlier. It shows all the charges to each party and all the credits each party receives, and it nets to the bottom line figure. Page 4 of the buyer's closing disclosure is just disclosures. It tells the buyer how the escrow account was set up, and it tells them that the property is collateral for the loan, just federal disclosures. Page 5 has 3 parts. The bottom part is a chart that shows the lender, the agents, the closing attorney, all the contact information. Another chart shows the APR, the effective annual percentage rate, and the third chart is additional federal disclosures. We also, in addition to a closing disclosure, we do an ALTA statement. An ALTA statement is just a ledger of all of the dollar figures, debits and credits, for both the buyer and seller. So it's a quick financial summary of the transaction. Make sure when you review an ALTA statement or closing disclosure, all of the contractual concessions and negotiations are accurately reflected. In the example I gave you about my son, the contract said the seller will pay up to $4,000 in closing costs. Look at it. Do we have $4,000 of seller paid closing costs? Are the commissions on there? The seller agreed to pay the agent a commission. Is it on there? Did we accurately reflect the earnest money? are each of these financial elements. So use your contract as a roadmap to analyze your closing statement. Take your contract and say, do we have the sales price correctly? Do we have the earnest money correctly? Do we have the seller concessions correctly? And using your contract will be a guide to walk you through the closing statement to make sure everything is accurately reflected. Dana, at this point, I will tell you that we have covered everything that we had on our outline and syllabus. And I'd like to tell everybody, I apologize for running a couple of minutes late, but I do hope that you found a lot of value to the class. And what I always say is, in the words of the Kenny Rogers song, The Gambler, I hope you found an ace that you can keep. I hope you found something made the class worthwhile. Dana, I'll turn it back over to you. If there are any additional questions, I'll stay on as long as needed.
Awesome. There was one other question about, can a closing attorney close the same day they get the package from the lender, or the clear to close from the lender?
The answer is, in most cases, the lender is the pacing item. When the lender is ready, usually the closing attorney is also ready. What happens more often than not is I'll have a party call me and say, I want to schedule for 10 a.m. tomorrow, and I call the lender and they say, we're not going to be ready at 10 a.m. tomorrow. If the lender says they can be ready at 10 a.m. tomorrow, in most cases, the closing attorney can as well, unless there's some other outstanding reason that would be unusual.
Awesome. Doug, thank you so much. Such a pleasure, and just such a fabulous opportunity to have any classes regarding real estate from a closing attorney's perspective. And I know you do a lot of business and have been in business for a long time. If you'll go ahead and type in your contact information in the chat function. You guys, if you have any questions regarding the class or anything regarding closings or timeframes or areas that Schaefertz and Dean serves, Doug will be more than happy to answer that. Again, CE credits will be recorded within 3 to 5 business days. Once again, please type in your name, email address, and license number. One more, congratulations on your son's closing. Thank you for the class. If a property is foreclosed on, does it have to be sold on the courthouse steps? I'll let you take that one, Doug.
The answer is yes, and that is, it sounds funny, but that is actually Georgia law. And even at that, when a foreclosing attorney goes to the courthouse, if they've never been to that courthouse before, they ask the clerk, where are the official steps where I conduct foreclosure sales? So I always thought that that was just a figure of speech, that they foreclose on the courthouse steps. And the foreclosing attorney literally goes to the courthouse in the county where the property is located, and they find the designated place to conduct foreclosure sales. And it's typically a set of steps near the entrance to the courthouse.
In Georgia, it is what it is. Yes. All right. Any other questions, anybody?
The other interesting thing about the courthouse steps is sometimes there is nobody there to bid on it. And the closing attorney sits there and reads the whole presentation to nobody because they have to go through the procedure.
All right, and Doug has typed in the chat his name and contact information. So please make sure to see that. All right. I have recorded this presentation. I did put in the chat where it will be posted. So as long as there were no technical glitches, this will be posted. If you go to eagentweb.com, click on training videos, and then you will scroll down for this class. Also, I have a general YouTube channel called Real Estate Made Crystal Clear, and it is Georgia real estate specific. And if you go there, I've got a whole playlist called CE classes. So you may go there. All right. Anything else? All right, Doug, thank you so much. It has been a pleasure as always. Thank you guys, everybody. Lots of buyers and sellers out there that need your help. So please go bless them with your knowledge, your expertise, and your license. If you guys have any questions, I see a question on CE credit. You'll have to email me separately, dana@maximumonerealty.com, and I'll check on your CE credits. All right. Thank you guys
everybody
so
for coming.
Thank you.
Bye,
Try the veal. I'm here through Thursday.
Tip the waiters.
Right, exactly.